Welcome back. We are now in segment 7.5, and in this segment we'll be discussing about project costs. So remember, we are in term loan appraisal. We are discussing the dynamics of term loan appraisal, and in this segment we'll be discussing the project costs. We discussed the major components of any project, or the project cost and the means of finance. So let us get into the project costs. So the major items usually you come across in a project cost are land and land development, building, civil works and other construction works, plant and machinery, furniture and fixtures, preliminary and pre-operative. These are all the tangible assets, right? Tangible fixed assets. And then we have some other items like preliminary and pre-operative expenses. This includes items like interest during construction and some other items, provision for contingencies, and finally we have the margin for working capital. Okay, so let us look into each and every item and what are the points that you need to look into as a credit officer when you're looking at these items. Okay, the first item is the land and land development. So here you have to be very careful about the land rate. So in a project cost, what the company is saying is, right, the project cost the company is saying land cost is say 40 crores. And finally, the other items put together, finally, a company is arriving at the project cost of 200 crores. This is a big project, and the land is forming a very substantial portion, 40 crores. So you have to see how this 40 crores was arrived. It's very important. Just because the company has said the land is costing 40 crores, you can't accept and finance your term loan. Okay, you should be critically analyzing each and every item and the reasonability, what we call as reasonability, right? Each and every of these items, the project costs, are they reasonable? So what is the basis for assuming this particular cost? So land rate have to be very important. The first point you have to understand is the assumption. What is the land rate per acre assumed? So how the land rate in the project cost, when the company has said it has 40 crores, how did it arrive at the 40 crores? What is the total land extent? What is the total number of acres, and what is the rate per acre? So this is an assumption. This is an actual figure. This is the land that the company is planning to purchase, or has already purchased, and what is that is actually the action that you cannot change. But this is the rate. This is an assumption. So this is an assumption. Okay. So what is the rate the company is taking into consideration while arriving at the land cost? Okay, so this is a very important assumption. Actually, if you see the best credit officers, actually they maintain a database. They maintain a database like this. So they'll have a small Excel sheet in where they will write the various locations. What is the approximate market rate per acre? This they'll be maintaining. Of course, date on which this is entered is also important. Maybe in May 2014 this is the rate. So it's very important you do that. Okay. So that you'll be having a very good idea what is the land rates in various locations. Okay. Also, this you can this will be helpful not just in the project land primary security, but also in the collateral security. So in various prominent residential areas in your city where the collateral is being offered, you can continue this list. Okay, what is the location? What is the approximate rate for collateral? You can also have the approximate building area, that SFT, right? SFT you can also have. So usually please maintain something like this. Maybe in a register or in an Excel sheet. So you may not be knowing the rates of various areas. Okay, but there usually in your office there will be some colleagues who are interested in real estate. In every bank there will be, in every office there will be some people who are interested in shares. Some will be interested in real estate. So get in touch with them. Just have a informal discussion. Know the various rates, or else you'll be, as a credit officer, you'll be in touch with various borrowers and various companies. So they'll be very much aware of this real estate rates. So just inquire when they come across. So what is the market? What is the real estate like in this particular area? What is the going rate? What is the market rate in this particular area? So what is the per SFT rate if of this in this residential area? What is this land rate in this particular industrial estate? So just have a informal discussion. Keep a database. Keep entering it. So if you make a habit like this and you update, say, once in 3 to 6 months, you'll be having a very good idea, and then you'll be in a good position to judge the reasonability of the good judgment to make a good judgment of this land rate assumed in the project. Of course, companies will be submitting what is known as valuation reports. Banks will be insisting to submit valuation reports. These are prepared by the approved engineers, approved panel of engineers of the particular bank. Okay, you'll be having this valuation report. In this valuation report, you'll be having the assumed rate. That is also one source where you can get. But don't take this straight away, because there could be some liaison between the party and the engineer valuation. Okay, so just be careful about this license. So sometimes usually the valuation will be on a higher side. So don't take this value as it is. Just cross compare it. So if you maintain a table like this, culled from various sources, maybe from your colleagues and from the borrowers, various sources. So you'll be in a better position to cross-check this value assumed in the valuation report. So land development is also included in this head. So sometimes not just purchase of land. This land might be in very bad shape. Maybe there is a lot of bushes and various other impediments to be using this land. So that it has to be developed. It has to be brought to a certain minimum level. So that cost is also included in the land cost. Sometimes land is taken on lease. It is not purchased. It's taken on lease. So in this case, there will be no land cost. But then sometimes in very big projects, what happens is that this lease cost is capitalized. We'll see what capitalization is. But in that case, it will also be included as a part of the project cost. Okay. Usually, what banks says, banks insist that the land cost be met entirely by the promoters, unless it is a very large project. Okay, for large projects, banks also chip in their margin, chip in their share of loan. But usually for small to medium size projects, what banks usually say is, let the promoters finance the land. We won't get into it. Okay, we'll finance the remaining items, building, civil works, and machinery. So usually banks see this as a risky investment, a risky area of finance. So I'm not saying banks don't finance land. That's not the case. Banks do finance land in many projects, but given a choice, they actually prefer the land cost to be met by the promoters. So needless to say, these are points which which I need not mention. The documents have to be very clear. The title should be clear. Okay, and the title should be clear. Documents you will be actually taken up by the legal department of your bank. But then, as a credit officer, you should understand that credit and law in banking are very highly interlinked. So you should be at least be aware of the basic terminology in the law department, right? So if you have a law officer colleague in your office, engage in some frequent conversations, get to know the various terminology, and you should be maybe not be an expert in assessing the clearness of the title, but usually a term proposal will be having a lot of enclosures, and one of the enclosures will be the legal opinion submitted by a banker, by a approved advocate. So make it a point to go through these legal opinions, right? Of course, your own legal department will be giving some opinion, but you should be aware of at least the basic terminology. Okay. So the other item in the project cost is buildings and civil works. This is a major component of the project cost. So some of the points that you need to keep in mind when dealing with civil works is, what is the basis for this work? What is the basis for this cost? This is a civil estimate prepared by the bank's engineer, right? So there will be a panel of approved engineers, and the company can get the civil estimate prepared by any one of the engineers on this approved panel. So the civil estimate will furnish detailed breakup of how this, for example, in the project cost, there is an item called a civil work, say it's 20 crores. So how this 20 crores is arrived, the detailed breakup will be furnished in the civil estimate. So construction area, rate per safety, what are the various facilities that the company need to have, what is the construction area, what is the rate per safety. So again, don't take the final cost as it is. Okay, you need not be a civil engineer to actually read the civil estimate. There will be some items which you feel they are not required, or maybe the rate assumed is higher, because you'll be dealing with a number of proposals. Okay, maybe the cost of construction they assumed per SFT is on a higher side. So be open to all these sort of gaps. Okay. Another important aspect when it comes to civil works is the approvals. For construction, approvals need to be taken from the local municipal authority. So it's very important that you call for plan approval. Okay. So when the company comes for project finance, you inquire what is the status of the plan approval. It has to be record. It has to be on record. Okay. So without it, construction cannot commence. Some banks actually go ahead and sanction the loan, and then stipulate it as a predisbursement condition. This usually should not be encouraged. Sometimes due to urgency you might be doing it, but it is never it is advisable to get the plan approval on record before taking up the proposal, because you cannot start construction unless you have the approval. Okay, so once you start the construction, once you commit funds, once the bank funds are committed, and then you don't get the plan approval, it will be your funds will be blocked. It will be a very, very risky scenario. Okay, so please ensure that always you have the plan approval on record. So the next item under project cost is plant and machinery, very major component. So what is the basis for this cost? Just as we have a civil estimate for civil works, here we have something called quotations. This will be given by the suppliers, the equipment suppliers. So we will call for quotations. The company will be submitting quotations from suppliers, and you have to ensure that the suppliers are not suppliers are the machines are standard make. They are of standard. The machines should be of a standard make. Okay, they should be of standard make, and suppliers are reputed. Okay, at least if you ensure these two, that will be all right. Okay, possibly you try to compare cost of the machines with similar proposals you have done. Okay, in some cases imported machinery will be will be a part of the project cost. So the machine cost will be broken down into indigenous and imported costs. For this, you sanction, for this important portion, you sanction what is known as front-ended FLC. This we'll see in chapter 9. Okay, there we'll discuss what this front-ended FLC is. So in some cases, companies will be purchasing second-hand machinery, maybe due to the cost factor. Maybe the cost of the original machine is high. They want to save some amount, or maybe it's not available. Shortage of the original machine. So banks will be having their own policies regarding financing second-hand machinery. You have to look into your loan policy guidelines. What are the guidelines? Usually banks will be having a higher margin. So normally if normally the margin is 25% of plant and machinery. Maybe for second-hand machinery they have a higher margin, like say 50%. So what they're saying is, in the first case, if the original machine will sanction up to 75% of the cost of the machine, whereas in the same case, in the second-hand machinery will be financing only 50%. So this varies from banks to banks. Not just the margins, but also they also will be having some other guidelines, like get a certification from engineer about the residual life. So this machine is going to work is all right, and it's going to work well for the next for a period of 10 years. Say. So your loan repayment tenor you stipulate is 7 years. So that's all right. It's all right. Okay. So these are the points you need to keep in mind when dealing with second-hand machinery. Please refer your particular bank's loan policy guidelines as to the exact guidelines you have in this regard. Then the next item on the project cost is furniture and fixtures. Again, this is the basis is quotations from vendors. You have to ensure that they are reasonable, right? Reasonable. Sometimes, as we discussed in the introduction, effluent treatment plants and railway sidings are also clubbed under this head. Okay. So this should actually lead furniture, fixtures, and others. Sometimes in large projects we have something called railway sidings and also the pollution equipment, right? Effluent treatment plant, they also clubbed under furniture and fixtures. So those are the tangible items we have discussed. That is the land building, machinery, and furniture and fixtures. Okay, so those are the tangible items we have discussed. Next comes a set of items known as these are not tangible, right, but they are very much part of the project cost. We'll see what are known as preliminary and preoperative expense. So first of all, this is not a tangible item, right, but this is a part of project cost. So you have to understand the project cost is not just about physical objects. What do you mean by project cost? What is the cost means? Whatever is the cost that is required to bring the project into commercial production. So all that will be project cost. You cannot just purchase land, right? Construct some buildings, erect some machinery, and expect the plant to start running, right? That doesn't happen. This is just physical objects you erected. You purchase land, constructed some buildings and machinery, some furniture you have, and then you are waiting. You're just waiting to some miracle to happen. It's not going to happen. Okay, there are some additional expenses that go into. There's some additional cost incurred in bringing this project into commercial production. So till the stage this project comes into commercial production, all the cost that is incurred comes into the project cost. So to start production, you need land building machinery that are obvious. So that are items of project cost. But in addition to this, there are some other expenses. Take for example, for the company to form, for the formation of a company itself, there will be some expenses, like for example, registration of company requires some fees to be paid to the ROC. So without incurring this expense, there cannot be a company, right? And then there will be various approvals that need to be obtained for starting this project. So all those expenses, what I'm saying is not just the land building machinery, right? All those expenses that go into bringing the project into production till the stage, whatever the cost incurred will be, will also be a part of project cost. So many bankers actually think that preliminary preoperative expenses is a single term, but they are two separate terms. So preliminary expenses are different and preoperative expenses are different. So preliminary expenses are expenses which are incurred upon the formation of the company. Okay, like company registration fees, TV report preparation, market survey, right? Some consultancy services, all these are incurred on the formation of the company. So there's something like a deferred revenue expenditure, in the sense that if you incurred a huge expenditure and you don't want to push this expenditure into the P&L account of one particular year, you want to spread this over a period of, you want to write this off over a period of time. Because say for example, you incurred an advertisement at the launch of a new product. Now this benefit will be accruing to you over a period of time. This is not for one single year. So what this is like so this preliminary expense is like a deferred revenue expenditure. You will get the benefit over a period of time. So you write it off over a period of time. So what you do is you transfer it to the P&L account and write it off every year from the profits of the business. So on the asset side, you're going to show on the head called miscellaneous assets, right? This will be appearing in the balance sheet under the asset side intangible assets. There we discussed intangible assets. There we discussed an item called preliminary and pre-operative expenses to the extent not written off. There you'll be getting this amount. And actually the Income Tax Act speaks about this preliminary expenses to be written off in a 5 years period. Okay. Now pre-operative expenses are different. Pre-operative expenses are connected with the action of startup of the operations, such as salaries, wages, and raw materials. So these can be capitalized to the assets and depreciation can be claimed. Okay. So before commencement of commercial operations, all expenses incurred are termed as pre-operative expenses, which are actually they are pending allocation to fixed assets. So what happens once commercial production starts? They'll be capitalized and they capitalize and push to the gross block, and then they'll be depreciated thereafter. Okay. So pre-operative expenses are to be capitalized if it relates to fixed asset and should be charged to P&L account if it's of revenue in nature. So this exact accounting part is something which you need not be worried too much. Might seem a bit advanced to you, but understand that preliminary expenses are different and pre-operative expenses are different, right? Now a very important term under this concept of preliminary and pre-operative expenses is IDC. Okay, what is known as IDC? IDC is the interest during construction. So to understand that project construction takes time. Okay, so we are saying Jan 2014. The construction of the project, acquiring of the land from the local people, then the obtaining approvals, starting of the construction, ordering the machinery, arrival of the machinery, erection of the machinery. So this is a lot of time. Say for example, this project is completed in December 2014. So the company will be availing a term loan at the starting of the project because to undertake this construction they need some funds. Okay, so the project is not generating any funds here, any profit here. The production has not yet started. It's taking 12 months for the project to commence operation. So during this period the company has to pay some interest. Okay, the company has taken loan and has to pay interest, but it has no sources of income. The production has not yet started. So banks won't say you're not generating revenue. We are sympathetic. Towards you, we are not charging interest. Banks won't say that. So this interest expense during the construction period is known as IDC, interest during construction. What is IDC? During the construction period, when the company is not generating any income. The company is not generating any income because production has not yet started. Right? There is a time gap between the start of the project and the commercial operation. There is a time involved. A huge projects might take 3 years. A major power plant might take up to 3 years. So during these 3 years, there won't be any income to the company, whereas the company keeps on incurring expenditure and it has to meet this project cost from some portion from the term loan. So there is an interest expense for this term loan, but the company is unable to pay because it has no sources of income. So this interest expense during this construction period is what is known as interest during construction. IDC is the interest expense during the construction period. So you have to understand that IDC is not like a regular interest. So we have seen already interest in the P&L account. So this IDC is a bit different. Okay. Once a company starts operation in the normal running course, there will be an interest expense. Okay, that will be debited to P&L account. That is normal. There is a normal expense we have seen in the P&L account. That is different. That is okay. But IDC has a slightly different treatment. So what we do in IDC is the interest during construction. This is as per the accounting, as per AS 16, right? This is the accounting standard issued by ICAI, right? As per AS 16. Now this IDC should be capitalized, right? What do we mean by capitalized? It means it will be pushed to the asset. We'll be adding this to the cost of the asset. It will be a cost of the asset, right? And then it will be depreciated, and then it will be depreciated as a normal fixed asset. Say for example, a machinery is costing. The total block of machinery is costing 10 crores. Maybe the IDC component is some 1 crore. So now we take this 11 crores as the entire cost of the machine and then we depreciate it. So normally we depreciate this amount. So what we do, we capitalize this interest expense and add to the fixed asset component. And then we depreciate this as we would depreciate any other normal fixed asset. That is known as capitalization. Usually banks won't finance this IDC. But some banks have a policy of financing up to 50%. Again, this varies from bank to bank. So usually IDC is met by the promoters. Usually 100% margin is stipulated by the banks. Okay. A bit of advanced topic, interest during construction. Just understand the concept. It is the interest expense. Okay. It is the interest expense during the construction period. If you understand this, that is more than enough. So the actual treatment might be a bit advanced to you, but if you can understand, please. But if you're all right with it, please understand that it's going to be added to the cost. It is going to be capitalized. That is, it is going to be added to the cost of the asset and then it will be depreciated as a normal fixed asset, right? It will be depreciated thereon. Then we have an item called provision for contingencies. So project completion takes a lot of time. So there will be various ups and downs, right? So whatever is the project cost which you have initially assumed, it might go up. there might be what we call as escalation, project cost escalation. Okay. So initially you thought the project cost will be 60 crores, but ultimately it might end up at 75 crores. You don't know. For example, at the start of the you have arrived at 60 crores based on some assumptions, maybe steel rate or cement rate based on some assumptions. But during this 1 year period, the cost of cement has gone up. Maybe the labor charges have gone up. So various factors have contributed to the increase in project cost. So what usually actually is done in project cost is there will be a separate item called provision for contingencies. Okay, right? They'll be including this in the project cost. And again, this is not usually financed by the bankers. It's usually brought in by the this is usually financed by the this is usually 100% margin is stipulated. And now you have to understand that this might happen or might not happen. A company has said it is going to, it expects the project cost to be 60 crores, and there is a provision of contingency, and this includes a 5 crores contingency. Right, 55 crores is the actual project of all this land building and all. It is also added a provision for contingency 5 crores, ultimately added at 60 crores. It might be possible that ultimately the project cost is only 55 crores or less than 55 crores. You don't know. It might happen. It might happen. This 5 crores is actually never brought into picture. So in that case, obviously the promoter's contribution will come down. If this finance entered by the promoters, say for example, this 60 crores you have, 45 crores by the bank loan, term loan, and 15 crores by the promoters, right? And while arriving at this term loan eligibility of 45 crores, you have not taken the provision for contingencies. So bank has not 0%. Bank has not financed this contingency. 100% was met by promoters. In such case, what happens is should the situation arise where this 5 crores was not spent, so obviously the promoters then need to bring in only 10 crores, right? Because that did not arise. Okay. One more point on the project cost which we discussed in the introduction. A very confusing point. Why many bankers ask why margin for working capital is included in term loan project cost. Okay, project cost should be included only related to the fixed items. Why is this working capital included? Here, this will be discussing in the next chapter. We'll be having a better clarity. So if possible, there is one way to check the reasonability of project cost. So usually there will be what is known as industry average. For example, it is commonly agreed that to construct a thermal power plant, the cost is approximately 6 to 7 crores per megawatt. You see, this is not true in every case, but on an average, this is what it is an agreed figure, commonly agreed that per megawatt you need for the thermal power project you need 6 to 7 crores. So if it is a 100 megawatt plant, a reasonable cost would be around 600 to 700 crores. So you have to understand that each project is unique, cost will vary, but this will serve as an average benchmark. So you can use it as a guide. Okay. So tomorrow if you get a power plant for 200 megawatts, maybe you can see the project cost. Maybe the project cost is 2000 crores. Okay. You have this rough idea that per megawatt is going to cost 6 to 7 crores. So maybe this should cost around 1200 to 1400 crores. So why this is higher? So then you can drill deep and find out what is the reason for projecting a higher project cost. Okay. So similarly, you can try to find a average value for various industries you are dealing in your particular zone where you are functioning. Maybe there are a lot of steel units. Maybe there are a lot of cement units. Maybe there are a lot of rice mills. Right. So per ton or per megawatt. So just try to understand what is the average cost in this particular industry, and this how you can get, you can have just by talking to the companies, right? They are an excellent source for getting that information. If you have a rice mill borrower, just talk to him, right? For example, you can say one of our parties is planning to set up a 5-ton rice mill. What might be the possible cost? If you just ask them, they'll be more than happy to tell you, because they are in this line of activity. They'll be knowing very well. They'll be saying to construct this. They'll say based on the current market and this will require so and so. They'll be an excellent source because they are in this line of activities. So keep engaging in conversations with your borrowers, on various points, right? There will be a great source of information. So with this we come to the end of the segment. In the next segment, that is 7.6, we'll be discussing about means of finance. Okay.